Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis on Monday, November 17, 2014. Almost forgot what day it was. Okay, so we're looking at a daily chart of the SPY, and again, for like the 12th day in a row, it was just a nothing day. Market grinded a touch higher, which is only due to a buy program pretty much at the end of the day. Let's just take a look and see if that was so. Yeah, a little bit, just a little bit of a buy program right at the last candle of the day, just to bring the markets back up above the flat line. And that's what we've been seeing, as I showed you on Friday. We've been seeing that day in and day out. But all in all, it was really a narrow range day, which means the high of the day and the low of the day were, not that far apart. So, the market is still in that indecision point where it's either going to break up or it's going to break down, and not looking for a big breakdown, as I discussed on Friday. And frankly, I'm not looking for a big break up either. If we break up, there could be maybe 1% on the upside, maybe 1.5% on the upside, more or less. On the downside, maybe, like I've been telling you, 195, 196, 197, somewhere in that neighborhood. And the number continuously rises a little bit because the market's rising a little bit. So as the moving averages move up, so do the target prices if we should have a correction. And there's really not much else to discuss on the S&P today or the SPY because not much happened. But I do have some commentary. Let me run through a couple of the other markets, and then we'll shoot back, and I'm going to give you a theory of what I think's going on. So let's go over to, let's go over to the IWM. I love to talk about the IWM when and if I see, talking and typing, here we go again. When and if I do see the IWM as a leading indicator, and potentially it's becoming once again a leading indicator. Leads up, leads down. Well, right now the IWM was down slightly today. Let me get you the percentage. The IWM was down 0.64, which is 0.64 basis points, basically a little more than 0.5%. So the SPY was actually up 7 basis points, or 0.7%. So that's a divergence that we should take note of. That's been developing over the last couple of days, as you can see here with the IWM. And I think it's interesting because, time and time again, it works until it doesn't. So the IWM potentially is leading the market into a slight correction, and we'll see if that holds true over the next several days. But that's where we are. So small business in America leading the charge once again. Let's go over to the gold market, and gold didn't do much today. The GLD was down 42 cents. Really, the gold futures contract didn't do much. It was up and down a couple of bucks here and there today. It really didn't do anything, and we probably should see a pullback before moving higher in the price of gold. And I do think we're going to move higher. And this is part of that commentary I wanted to discuss. So before we get there, if you have another few days, maybe a week of sideways to slightly down market movement, I would look for higher prices in gold. I do think there's higher prices coming. And here's the thing. Well, before I get there, let's just go to oil real quick. USO. Not much happened. The price of oil was down slightly today, and but you are going to start carving at a bottom in the price of oil here pretty soon. And here's the deal. Let's go back to gold. So, whoops, bear with me. What's going on with the chart? Okay, sorry about that, folks. Okay, so I'm going to go to a longer-term picture of the chart. All right. And let's go way long. Let's go to a monthly chart. All right. Now, here we are. So for the better part of a year and a few months, okay, we went sideways and then we broke lower. So we made a high in 2011. Okay, then we started down. We challenged the high. We failed, and we sold off from September of 2012 all the way to June of 2013, and then we went sideways for the next year and a few months. And then we broke lower, and we took out the low, these lows here, this low, and this low. We took it out. Now, what does that mean? That means once we took it out, you saw everybody start to get bearish in gold. The media got bearish, analysts got bearish, gold's going down below 1,000, gold's going to 800. There's no more reasons to own gold. All the reasons we owned gold before are no longer valid. All the stuff came out. And that's at the point, and it's almost like the magazine indicator. And what's the magazine indicator? Go back to the real estate market in 2005, 2006, and you see the cover of Time magazine or Money magazine or Fortune magazine, which is, you know, your house is a piggy bank, buy a house, sell it tomorrow for a profit, all that stuff. Well, you know that's not realistic thinking. And when you start to see things like that hit the cover of magazines, it's usually closer to the end of a move than it is the middle or the beginning. And keep in mind, usually the best moves in any market come towards the end of a move. Case in point, what happened here? This is a monthly chart. So the month of August in gold, August of 2011, was the GLD started out at about 158, and it went all the way up to the high was 184. Okay, that means that the gold futures were up 300 points in the month of August. What that means is that was the best move, and it came at the end of the move. All right? So the point is that here's what I think is going on. I think gold is either in the process of bottoming or has bottomed, okay? And I think what that's telling us is, I think it's telling us that the global central banks are intent on creating any inflation they can. And what that means is, what I think has been going on is, I think over the last several years, they've been really fighting deflation more than creating inflation. The Federal Reserve here, now the central bank in Japan is going to have a $2 trillion money printing exercise. And what I think is coming next is go across the pond to Europe, and you have Mario Draghi trying to convince the German Chancellor Merkel that he wants to print euros. And today, and this is one of the main reasons I'm bringing this up, today Cameron over in the UK indicated that he sees a recession coming, and he's concerned about the global economy and a global recession. And what that tells me, and when these leaders, specifically the highest leader of a particular country, whether it's the President of the United States, the Chancellor of Germany, or Japan, or whatever a case is, when they say something, they don't say things off the cuff. They don't say things by accident. When they say something, it's said for a meaning. So their intent is to say something to telegraph something that's coming or to get a reaction. So, for example, when our government leaks something, when our administration leaks something to the New York Times, and you see something come out in the New York Times and everybody talks about it, they gauge whether the public is receptive or not receptive to a particular issue that they're thinking about. That's the same thing in my mind that went on today in the UK. Cameron came out and he said that he's concerned with the global economy. He's concerned with a recession in the UK. He sees what's going on in Japan. And I think that was a programmed response. I think it was, or not a response, I think it was telegraphing what's going to happen. I wouldn't put it past Europe, not only the UK. Now keep in mind, the UK can print their own money. They can print pounds, and the rest of Europe, or the majority of Europe under the euro, is trying to print euros. So Draghi's trying to get approval to print euros. So think about this. We stop printing money here. Japan starts, and then the UK starts, and the rest of Europe with Draghi starts printing euros. And what happens is, this will be the last phase of them trying to create global inflation. And if that's the case, you will see gold rise precipitously. You will see gold rise for two reasons. Because there really is inflation on one hand, or there may be inflation on one hand. Or the second reason is if people think there's inflation coming or inflation here, and they think they need to buy gold because of inflation, people will buy gold because other people are buying gold. And that simply stated is buying begets buying. And that's what I think is going to happen. So I think that gold will rise, okay? And I'm not sure exactly how far it will rise, but I can tell you right now there's at least $200 on the upside in the near term once we start rising and get over, well, let's go back to a daily chart and I'll show you where I'm looking at. So, once we get over this 20-period moving average and over the 50-period moving average, then we challenge this high here. Then we challenge the 200-period moving average, which is this gap in here. And that is about 124 in the price of GLD, which is $10 higher, which is basically $100 in the price of gold futures. Now, I think that could be just the beginning. Now, nothing goes in a straight line, and there'll be backing and filling, and there'll be pullbacks and corrections and all that stuff. But I think the rest of the commodity sector will rise along with it, namely oil. Now, why do I say that? Everybody, just like gold, everybody's talking about oil's going down to $60 or $50 a barrel. The global economy is contracting. We're going to use less oil. We're going to import less oil. We're going to export less oil. All that nonsense. Well, guess what, folks? The world is run on oil. Like it or not, the world is run on oil. And it's not just in our cars and trucks. It's in everything we have. There's a lot of things, and I don't profess to be an expert in this, but I do know that a lot of things, material things, are made with petroleum. Okay, that's not going to end anytime soon. So the whole point is that when the if there's global money printing and the money really finds its way into the real economy, which didn't happen when our Federal Reserve printed all that money, it basically stopped at the banks. Okay, once the banks start lending money and Europe starts printing money and Japan continues to buy equities with the money they're printing, what do you think's going to happen? Don't fight the central banks, especially global central bank synchronized money printing. Don't fight it. It's not a guess. My theory is that in 2015 we're going to see commodity inflation, we're going to see stock market inflation, we're going to see money printing, we're going to see pounding the table that everything is great, the economy is great, this, that, and the other is great. And keep in mind, it's going to be short-lived. I don't know exactly how long it's going to last, but what I can tell you is there will be fits and starts, there'll be corrections just like any other market, but look for global money printing to take hold in 2015. And that's the theory that I'm working off of right now. And what I'm going to do is I'm going to put together over the next 2 or 3 weeks, I'm going to put together a forecast for 2015. And basically, I'm going to let you download it. You can read it and you can make your own opinion on it. And then you can hold it and see if I'm right after the fact. But that's where we are. Now, just switching gears a little bit, we've got some interesting trade alerts coming. We have an active trade alert right now that's in the money, and it's on the short side. So I do think there is a slight correction coming in the stock market, but I don't think it's going to be large, like I said. And I've got a couple of more short trades I'm eyeing, and then I've got a whole laundry list of long trades that I'm eyeing for when the correction does take hold, and then we can take advantage of the long side of the market. And I think that's going to be those are going to be some great trades. So the members are going to get those shortly. And for now, I'm going to leave it there tonight. I know it's a longer video than I normally make, but I wanted to get that point across about the global synchronized money printing concept. I think it's very important. And that's about it. So I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.